Hi. Today we are going to present the audit planning and fieldwork. First of all, what is audit planning? Audit planning is an activities that involves general strategy and detail approach for the expected nature, timing and an extent of an audit. Why do we need to plan an audit? Firstly, it is to enable the auditor to obtain sufficient competent evidence for the circumstances. Next, to help keep audit costs reasonable. Besides that, it is to avoid misunderstandings with the client and to achieve audit objectives. Lastly is to minimize the possibility of audit failures. Next we are going to talk about pre-plan, which is about client's acceptance. For new client, investigation towards the new client is needed because we need to know the background of the company, also their relations with previous auditor. And we need to apply procedure to communicate with predecessor auditor. The successor auditor should get the prospective client's permission to communicate with the existing predecessor auditor. If the permission is not given, the successor auditor should decline the appointment. For continuing client, they should determine the reasons for not continuing to do the audit. For example, is there any previous conflict over scope of audit, the type of opinion to issue or audit fees? Or there is any excessive risk exists? Next. Fraud and error. What is fraud? Fraud is intentional misstatement of the financial statements, for example, a clerk taking cash at the time a sale is made. While error is unintentional misstatement of the financial statement, for example, mistake in extending prices times quantity on the sales invoice. Last scope is the setting of audit objectives. Management assertions is defined as implied or expressed representations by management about classes of transactions and related accounts in the financial statements. It acts as the criteria that management uses to record and disclose accounting information in financial statements. There are 7 categories related to audit objectives. There are existence, which concern whether assets, obligations and equities included in the balance sheet actually existed on the balance sheet date. Occurrence, which concern whether recorded transactions included in the financial statements actually occurred during the accounting period. Rights and obligations, which concern whether assets are the rights and liabilities are the obligations of the entity at the given date. Completeness, which concern whether all transactions and accounts that should be presented in the financial statements are included. Valuation and allocation, which concern that whether assets, liability, equity, revenue and expense accounts have been included in the financial statements at appropriate amount. Measurement, which concern whether a transaction or event is recorded at that proper amount and revenue and expense are allocated to the proper period. And lastly, presentation and disclosure, which concern whether components of financial statements are properly combined or separated, described and disclosed. Next is the knowledge of clients' business and industry. Industry and the external environment means there are risks associated to all clients in certain industries. Additionally, there are varying accounting requirements that the auditor must take into account in assessing whether or not to serve a particular client. Business operations and processes means the auditor must strive to understand how the business works. A company tour is a step toward getting some familiarity, particularly if questions can be directed to some of the employees. In addition, identifying transactions with related parties is a necessary step in understanding the business. Next, is client business risk. Audit risk is a situation where in order to give an unqualified audit opinion when the financial statement is materially misstated. There are 3 types of audit risks. First is inherent risk. Factors used in assessing inherent risks are nature of client's business, integrity of management, client motivation, client's knowledge of accounting standards and nature of client's inventory and technological development. Second risk is control risk. Control risk exists due to the inherent limitation of internal control system and inadequacy of the segregation of duties such as human error and faulty judgment. Lastly is detection risk. Risk that the auditor's substantive procedures and review financial statements will not detect material errors, misstatements. Next is preliminary analytical procedures. It helps in guiding the audit planning. Besides that, it helps in making a comparison based on large and small amount where the focus of audit that might be understated or overstated. There are 3 types of preliminary analytical procedures. 1. Industry data. 2. Similar prior data. 3. Budgeted data. Lastly, materiality. It is principle in accounting that trivial matters are to be disregarded and all important matters are to be disclosed. There are 2 types of materiality. 1. Qualitative, it needs more evidence to reduce materiality and arose out of a conflict of interest or a potentially illegal act. 2. Quantitative, it based on amount and the aim is an attempt to establish some consistency. That's all from us. Thanks for watching.